So here we are now on the next unit on corporate actions. We're going to want to make sure that we understand these, and I do have additional resources to help with these, primarily about the splits and reverse splits. But there are different types of corporate actions that we need to be aware of, some more than others. Most of these are going to require both a vote of the board and the shareholders. Some won't. I will let you know which ones don't. Splits. These are going to require shareholder approval and the board, of course. All corporate actions are going to require board approval. But splits are designed to decrease inexpensive security to get more people interested, splitting the security into multiple securities worth less, but total worth the same. We also have reverse splits. These do require shareholder approval as well. These are designed to increase a cheap securities price to get the price into a more favorable position, to potentially keep it from getting delisted if there are minimum prices to get on certain exchanges. This is the opposite of a split. This is taking a lot of cheap certificates and sort of combining them into one more expensive security, or at least less more expensive securities. Buybacks do not require shareholder approval. This is simply the company purchasing its shares back on the open market to increase the treasury stock. When a company buys its own common stock back, it becomes treasury stock, and they do so through buybacks. Tender offers are a type of public takeover bid. These are taking over another company, where they're offering to the stockholder of a publicly traded company a fixed amount for their price. It's subject to a tendering of a minimum and a maximum number. If I'm trying to do a takeover, I might say I need at least 20% of the stock, but I don't want any more than 55% of the stock. So if I don't get at least 20% of the people willing to tender their shares, I don't actually have to pay for any offer in this. But if I get 80% wanting to tender their shares, I only need to take the first 55 if I'm making this. And it's usually going to be done at a premium, because if I was going to be trying to buy a large amount on the open market as I purchased, as we see from dealing with market makers, as we keep buying, the price is going to keep going up. So if we want to sort of keep it simple, we're going to offer more than what it's currently at to see if we can get the number of shares that we're looking for. An exchange offer is like a tender offer, but securities are offered instead of cash. The trading of it. I'm trading you my securities for yours so I can take over your company. In certain situations, I don't really know of any off the top of my head of takeovers, besides, like, I guess AT&T took over Singular, where they went and could have offered Singular shareholders AT&T stock in exchange for their Singular shares. So then AT&T gained control of Singular that way. Possibly. I'm not exactly sure, but that's one of the ways a takeover could occur. Rights offers, an issue of rights to existing shareholders that entitle them to buy additional shares from the issuer. This is done within a limited period. We learned about these from rights when we spoke about them in an earlier chapter. But when new shares are offered, the current shareholders must be given preemptive rights to maintain their proportional ownership. Mergers and acquisitions. These also require shareholder approval. On this page, the tender offer and the exchange offer are going to require shareholder approval. Technically, I guess a rights offer doesn't really require shareholder approval, but the actual issuing of new shares does require shareholder approval. So the shareholders definitely get a vote in there. They don't get a vote on whether rights are issued or not because the law says they have to be. But they do get a vote on whether or not they're going to issue more shares. But mergers and acquisitions, this is when two companies combine into one. That's a merger, AT&T, Time Warner. Or when one company takes over another, acquisition. And for acquisitions is where the tender offers and exchange offers are useful. Adjustments to securities. The total value of the portfolio doesn't change. It's simply the number. The cost basis per share is always going to be found by taking the total cost basis and dividing that by the total number of shares. Unless you invest more or sell some of what you've already purchased, the total cost basis can't change. But the number of shares could theoretically change. If the number of shares is increasing, like in a stock split, that means each share decreases in value proportionally. So the total value stays the same. We multiply your previous number of shares by the split. Splitting 1 to 3 means we multiply by 3. Splitting 3 to 5 means we're multiplying by 5/3. We're increasing the number, so the higher number needs to be on the top of this fraction. Remember, you will have more shares. If you have less, flip the fraction, because that's a reverse split. If the number of shares is decreasing, reverse splits, that means each share increases in value proportionally. So the total value remains the same. You want to multiply your previous number of shares by the reverse ratio. Reverse 2 to 1 means we're multiplying by 1/2. If reversing 7 to 3, that means we're multiplying by 3/7. Now the smaller number is on top. Remember, you will have less shares. If you actually have more shares, you want to flip the equation because you're actually dealing with a stock split in that case. Splits and reverse splits in English. I am going to cover them in a lot more detail now, and I do have additional resources below. These are a topic that are getting discussed. A split is taking some shares and making them more shares. A 3-for-1 split, that is an even split. If there is a 1 involved, it's an even split, or even reverse split, as we're going to talk about. If it's not, it's an odd reverse split, an odd split. And I have been hearing from students that they are seeing odd splits and reverse splits. But a 3-for-1 split means every 1 share now becomes 3 shares. A 7-for-4 split means every 4 shares now becomes 7 shares. A reverse split is taking some shares and making them fewer number. A 3-for-1 reverse split means every 3 shares becomes 1 share. A 5-for-2 reverse split means every 5 shares now becomes 2 shares. Stock splits. We must remember the total value never changes. With a split, the number of shares is increasing. The value of each share then is decreasing. Example of a 3-to-1 split. We start with 200 shares at $60 a share. The shares increase to 600. Every 1 share now becomes 3. Since we had 200, 200 times 3 is 600. The cost is going to decrease to $20. Notice, though, if we look at how much we started with, we had 200 shares at $60 a share. That's $12,000. We ended with 600 shares at $20 a share, the same $12,000. We just have it broken up now into more pieces. Reverse splits. The total value still never changes. With a reverse split, the number of shares is decreasing, but the value of each share is increasing. Example of a 4-for-1 reverse split. If we start with 1,000 shares at $8, every 4 shares, and we have 2,500 4 shares for 1,000. Sorry, not 2,500, 250 4 shares for 1,000. We have 2,500, 250, I keep doing that, sorry, 250 shares afterwards. We divide by 4 here, or multiply by 1/4. But that also means each share went up in 4 times the value. So the cost now per share is $32. If we do the math, we have 8,000 before and 8,000 after, the same value. The value never changes. Stock splits and reverse splits. Stock splits, again, to increase shares, then lower market price. Used to decrease stock price, to increase marketability. If you go and look up, my favorite company to talk about and show people is one called Berkshire Hathaway. All you need to do is type into Google BRK hyphen, the little dash, A, and look at what the stock price of Berkshire Hathaway is. And I want to make sure when you do this, you understand that your eyes aren't deceiving you. No, there's not some error on the screen. Yeah, that number is over $300,000 for 1 share. You can also look and see there really aren't that many of those shares trading on a day. Each day, not very many shares of Berkshire Hathaway trade because it's so expensive. But just because it's expensive doesn't mean it as a company is worth more than another company. It's a big company. It's worth over $500 billion. But there are bigger companies. Microsoft is bigger. Google, Apple are bigger. Their share price is far less. More people can buy and sell Apple. That's an idea. If the share price is lower, more people can buy it. But the other side of that is if the share price is too low, people may think that it's junk and it may not be able to get listed. The New York Stock Exchange has a minimum price of at least $5 and in many cases higher than that. If the stock price starts going below that, companies may want to do a reverse split so they can stay on the exchange, so they still look like they are a good company instead of being worth fractions of what it appears they should be. Because that stock price does influence people's desire for the company, even if in the long run it really isn't that important because you've got to compare other things to sort of justify it. But it is a psychological idea. The people would rather spend $99.99 than $100, even though it's the same thing. So yet another example, if a client has 100 shares valued at $50 each, and the company does a 5-for-1 stock split. That means the client now has 500 shares, 5 times the number at 1/5 the value. Client has 200 shares valued at $60 each. The company does a 3-for-2 stock split, now an odd stock split here. Well, we're multiplying by 3 halves. We can think of that as dividing by 2 to get 100, and then multiplying by 3. We're then doing the exact opposite, where we're dividing by 3 and then multiplying by 2. Again, I have additional resources below. If you've got questions on this, reach out to me. I'll be glad to try and walk you through it some more. These are tested. If a client has 1,000 shares, now they're going to have a lot more shares generally when they're talking reverse splits, and they're valued at $5 each, and they're going to be at a lower price when you're talking reverse splits. If the company has a 5-for-1 stock reverse split now, well, we simply are taking 1/5 as many stock. We have 1/5 as much, worth 5 times the price. So we could divide by 5 to find out how much stock we have, and multiply by 5 here to figure out what the price per share is. That's an even reverse split. If we want to talk about an odd reverse split, well, the client has 900 shares, valued at $6 each. Company does a 3-for-2 reverse stock split. That means we're multiplying by 2/3. We're not multiplying by 3 halves. We would do that if this was a split. With a reverse split, the smaller number is on top. 2 divided by 3 times 9. 2/3 times 900. We're going to find out that's 600. We flip it. 3 halves in this case times 6 is going to be $9 each share. We can always double check the math. The one up top, we have $5 and 1,000 shares. That's $5,000. And with 200 shares, now valued at $25 a piece, that is also $5,000. 900 shares valued at $6 each, that's $5,400. $9 each of 600 shares is also $5,400. The value doesn't change. Today they voted for a stock split. That means my options that I purchased are now twice as worthless as they were. Always funny. Well, that brings us to the end of this unit. Definitely review it. As I have pointed out before, there are a lot of material below. The next unit is going to be on similar sort of mathy concepts, so I will have additional resources for them. And as always, if you have questions, please reach out. Suggestions on what else might help learn this material, and I'll be glad to see what I can do. Hope you enjoyed this, and I'll see you soon.